Today, let them eat bricks. The DFA Daily to the 31st of May 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. First today, a quick reminder of our live stream on Tuesday, where we will reveal the May 2020 mortgage and rental stress data and offer the chance for you to ask about a specific postcode. We've had many requests for this information, so we can look at the latest data in real time. And this is scheduled for 8 p.m. Sydney time on Tuesday, the 2nd of June, the day, by the way, that the RBA is due to meet next, and so we'll also discuss their announcement. Mark your diary and ask a question live or send them via the DFA blog beforehand. Meanwhile, according to news.com.au, we can expect more unnatural acts from the government to stoke the housing sector once again. Government is set to unveil new homebuyer grants across the board to prop up the flailing construction sector. The government will this week unveil generous grants for new home buyers, which will reportedly be on offer for everybody, not just first-time buyers. Experts have projected that house prices could see a dramatic fall due to the COVID-19 pandemic. In fact, CBA says worst case, prices could fall by 30% or more over the next couple of years if there was an extended recession and 9% unemployment. The next phase of government stimulus designed to revive the economy in the wake of the crisis will focus on housing construction, it's been reported. Treasurer Josh Frydenberg is preparing to unveil a mammoth new home buyers scheme that will be available for all Australians, not just first-time buyers, as has traditionally been the case with such grants. Sky News political editor Andrew Clennell revealed today the plan would be detailed this week in a bid to prop up the economically crucial home building sector. This will be across the board, not just for first home buyers, as the government looks to prevent a 30 to 50% drop in residential construction, Clennell said on Sky News. The government fears a collapse in residential construction activity will damage housing supply and put pressure on affordability in the mid to long term. Construction is also a major pillar of the national economy, with economists warning it's set to take a massive hit due to COVID-19. There are few details about what the grant will look like, how much, any thresholds on home values, and whether it's targeted at specific locations, but Clennell says a key feature of it would be to save construction jobs. And Labor has called for urgent government support for the housing sector for several weeks. Speaking on Sky News this morning, opposition Treasury spokesman Jim Chalmers cautiously welcomed the news. Let's see what they announced during the news, Dr. Chalmers said. Already, before the crisis, construction was relatively weak and home ownership was at 60 years low, so we had a challenge there. That challenge has been exacerbated by this coronavirus crisis. In 2 or 3 months, we are very worried that construction will fall off a cliff. And that's why we've been making very constructive suggestions about what the government might do. We want to make sure that their plans are comprehensive, and we hope that they will pick up and run with some of the ideas that Labor has put on the table. The opposition wants to see support for tradespeople in the building industry and a focus on investment in social housing stock, he said. And he also called for a program to house essential workers closer to where they work. We said we've got an open mind on grants, and as recently as yesterday we put an idea on the table to lift the cap on the loan deposit scheme to try and incentivise new builds as well, Dr. Chalmers added. The government's first home loan deposit scheme, a key election commitment from Prime Minister Scott Morrison, was fully subscribed in its first few months of existence this year, and it's been announced that it will run again from July. The scheme effectively provided a guarantee on first-time buyer deposits, meaning they would need as little as 5% of the purchase price to secure a mortgage. So no great surprise they're going to try and throw more money at the housing sector. As we've discussed on numerous occasions, it's to be expected completely. But of course it's completely misplaced and potentially will backfire. We should be investing much more in strategic infrastructure rather than just more houses. But that sounds like a bit too intelligent for the current incumbents. Meantime, Visual Capitalist had an interesting take on the virus titled The Road to Recovery: What Economies Are Reopening. They said COVID-19 has brought the world to a halt, but after months of uncertainty, it seems that the situation is slowly taking a turn for the better. Their chart measures the extent to which 41 major economies are reopening by plotting two metrics for each country: the mobility rate and the COVID-19 recovery rate. Mobility is referring to the change in activity around workplaces, subtracting activity around residences, measured as a percentage deviation from the baseline. And the COVID-19 recovery rate is the number of recovered cases in a country as measured as a percentage of total cases. Data from the first measure comes from Google's COVID-19 Community Mobility Reports, which relies on aggregated anomalous location history from individuals. Note that China does not show up in the graphic as the government bans Google services. And COVID-19 recovery rates relies on values from Corona Tracker using aggregated information from multiple global and government databases such as the World Health Organization and CDC. In general, the higher the mobility rate, the more economic activity this signifies. In most cases, mobility rate also correlates with a higher rate of recovered people in the population. And this is how countries have fared based on those metrics. In the main scatterplot visualization, they've taken things a step further, assigning these countries into four distinct quadrants: high mobility, high recovery. Here, high recovery rates are resulting in lifted restrictions for countries in this quadrant as people are steadily returning to work. New Zealand has earned praise for its early and effective pandemic response, allowing it to curtail the total number of cases, and that's resulted in a 98% recovery rate, the highest of all countries. After almost 50 days of lockdown, the government is recommending a flexible 4-day work week to boost the economy back up. Second, high mobility, low recovery. Despite low COVID-related recoveries, mobility rates of countries in this quadrant remain higher than average. Some countries have loosened lockdown measures, while others did not have strict measures in place to begin with. Brazil is an interesting case study to consider here. After deferring lockdown decisions to state and local levels, the country is now averaging the highest number of daily cases out of any country. On May the 28th, for example, the country had 24,151 new cases and 1,067 new deaths. Third, low mobility, high recovery. Countries in this quadrant are playing it safe and holding off from reopening their economies until the population has fully recovered. Italy, the once epicenter of the crisis in Europe, is understandably wary of cases rising back up to critical levels. As a result, it's opted to keep its activity to a minimum to try and boost the 65% recovery rate, even as it slowly emerges from over 10 weeks of lockdown. And fourth, low mobility, low recovery. Last but not least, people in these countries are cautiously remaining indoors as their governments continue to work on crisis response. With a low 0.05% recovery rate, the United Kingdom has no immediate plans to reopen. A 2-week time lag in reporting discharged patients from the NHS services may also be contributing to this low number. Although new cases are levelling off, the country has the highest coronavirus-caused death toll across Europe. And the US also sits in this quadrant with over 1.7 million cases and counting. And recently, some states have opted to ease restrictions on social and business activity, which could potentially result in case numbers climbing back up. Over in Sweden, a controversial herd immunity strategy meant that the country continued business as usual amid the rest of Europe's heightened regulations. Sweden's COVID-19 recovery rate sits at only 13.9%, and the country's minus 93 mobility rate implies that people have been taking their own precautions. Now, it's important to note that a second wave of new cases could upend plans to reopen economies as countries reckon with these competing risks of health and economic activity. There is no clear answer around the right path to take. COVID-19 is a catalyst for an entirely different future, but interestingly, it's one that has been in the works for a while. Carmen Reinhardt, incoming chief economist for the World Bank, says, without being melodramatic, COVID-19 is like the last nail in the coffin of globalization. The 2008 to 2009 crisis gave globalization a big hit, as did Brexit, as did the US-China trade war, but COVID is taking it to a new level. So the key question that they leave us with is, will there be any chance of returning to normal as we knew it? And now turning to the Fed, who this week only lifted their balance sheet by 0.9%, up a mere $60 billion net to a new high of $7.09 trillion. This is up by 78.6% from early September 2019, when the repo crisis hit, or $3.3 trillion. Yet more helicopter money for Wall Street. And finally, this from Damien Boy at Credit Suisse, which sums things up quite well. Credit growth surprises materially to the downside, they say. Bank credit was unchanged in April compared to the consensus forecast of 0.6% monthly growth. Year-ended growth slowed to 3.6% from an upwardly revised 3.7% versus expectations of a pickup to 4%. Compositionally, business and housing credit rose moderately, while personal credit fell. Arguably, the major source of downside surprise was in the business lending category, with firms not drawing down more heavily on their credit lines, which economists had expected. But we think that there was an interesting story to tell with regard to debt repayment as well. Housing investor deleveraging continues to negate owner-occupied debt holidays, they said. Although housing credit grew moderately in April, there were divergent trends between owner-occupiers and investors. Like we saw in March, investor credit declined while owner-occupied credit rose. Investor credit has been declining because borrowers have become much more uncertain about prospects for house price inflation amid low migration and heavy supply. They have also had to worry about non-repayment of rents during the shutdown phase. Therefore, they have chosen to de-risk and de-lever on their biggest overweight exposure in housing, having been wrong-footed on their risk assumptions. Investor mortgage principal payments have risen accordingly, and in contrast, owner-occupiers have benefited from debt repayment holidays granted by the banks, and their reduction of principal repayments has inflated the stock of credit. And then they said, strong money supply growth, but arguably not strong enough. Broad money supply is the broadest definition of bank deposits. In theory, deposits are created by bank lending and fiscal deficits. Also in Australia, there is the classification issue of cash held in superannuation accounts not being counted in the official measure of bank deposits. With all this in mind, it is an interesting exercise to dissect the strong growth in broad money supply in April of 2.9% in sequential rate of change terms and $60 billion in dollar terms. Clearly, bank loan growth did not contribute to deposit growth in April, but fiscal deficits should have added $24 billion, and arguably emergency superannuation withdrawals eclipsing $13 billion could have materially increased measured deposits to the extent that there was spare cash in these accounts to withdraw, or to the extent that proceeds that were not obtained by super funds selling assets to another member of the general public. In principle, conventional RBA quantitative easing should not have made a major impact on measured deposits, as the program should have been conducted as an asset swap with the banks rather than the general public. However, the bank has officially been buying bonds from non-banks as well, and so QE has probably increased deposits in the system. Indeed, in April, the RBA purchased $25 billion of government bonds. Also, the AOFM has been conducting purchases of private securities of non-bank lenders to support small business lending, and in April $190 billion of transactions were settled. Marrying up the data, we find that broad money supply growth in April cannot easily be explained by the sum of bank loan growth, fiscal deficit spending, emergency superannuation withdrawals, RBA QE, and AOFM lending. If anything, money supply growth should have been even stronger than recorded. This leads us to suspect that some of the money injected or freed up by policymakers have been used by the private sector for debt repayment purposes, as principal repayment destroys deposits, the flip side of new loans creating them. Either worry about deteriorating borrowing equity or deleveraging, they said. We find it quite concerning that non-repayment of debt is currently seen as the primary way of inflating the stock of credit. Indeed, with property prices falling, non-repayment of debt leads to incredibly sharp deterioration of the equity base of borrowers on a mark-to-market basis. After all, every 1% decline in house prices represents a 2% decline in the average equity base of mortgages because of leverage. But an even bigger concern is that despite the attempt to reflate the credit stock through non-repayment of debts, the economy is struggling to do so. Investors are reacting rationally to high uncertainty by de-risking and deleveraging on their housing exposures, counteracting policymakers' attempts to drive repayments lower. To be sure, if the economy fully reopens and population growth accelerates, perhaps there is not too much to worry about longer term. Everyone can cross the bridge that policymakers have tried to build, and life can get back to normal for housing investors. But the reality is that a full reopening of the borders is not on the table yet, because it is the riskiest decision that policymakers need to take in light of a possible second wave of COVID-19. The RBA is right to lobby for fiscal stimulus extension. In his late May testimony to Parliament, the RBA Governor Lowe recognised that the economy has been performing better than feared and applauded fiscal policy makers for their responsiveness to the crisis, but he also tried to persuade them to taper or extend programs like JobKeeper, while reminding them that at the zero bound, the burden of counter-cyclical easing falls more on them than on the bank, hence their reticence to entertain negative rates. With housing uncertainty high and deleveraging pressures lurking beneath the surface, the risks are that by September, when fiscal stimulus formally runs out, that the economy's credit impulse will be quite weak and in need of a boost. For what it's worth, we think, they say, that Lowe's view and advice is absolutely correct. And I would add, I think that is spot on, that we need to find a way to taper the support from government. We certainly can't create a cliff in September. And there needs to be a way to fade it through. But I come back to my central point that if, in fact, the government's main strategy for post-COVID stimulation is to throw way more money at the housing sector, partly to try and prop housing prices up, and to cajole more people to come into the property market and increase debt, then we have learnt absolutely nothing compared with where we were before the crisis. And I do think that both Treasury and the Reserve Bank and the government are all on the same Kool-Aid, thinking that more debt and higher home prices will be the cornerstone of supporting the economy. I wish that they would just change their tune, get real, and move to a different mode of engagement. But I don't think that's very likely. Leopards don't change their spots. Like it or not, we are going to find that the housing market is going to receive further intervention, it's going to be messed with again, and once again, the normal supply and demand economics that you would hope to see in the sector is probably going to be destroyed some more. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.